awesome stuff. Okay. Well then, I presume you can hear me. I've got a few things to kind of go over, basically. I've been I've been looking at the charts lately and kind of thinking about how people trade, how I trade, how I've traded in the past. And now more often than not, the more time you spend in the chart, the more time you see these clues about how manipulation kind of works and operates. And one of the things I just wanted to do is just spend a bit of time focusing on what we would perceive as patterns. Patterns in the sense that, you know, we as humans, we are very attached to these kind of ideas of patterns and where price tends to bounce off. I mean, I don't know if you can see what I can see, but just even without kind of thinking about it, you know, I can see if I take, you know, this line here, that looks like an area where we've had a number of touch points in the sense that the data points, right? So, you know, whether you want to suggest that these are all data points, think of it like this. You've got like, that's one data point, and the moment it becomes a trend is when you get multiple data points. So we've had a data point here, a couple of data points here. Forget about this for 1 second, and then we get another data point, and then another couple more data points. So the way we kind of think in the way we operate is we see these ideas and we think, wow, okay, this is a support. You know, we come down and we hit the support. But sometimes we get these like points where actually it's not so much a support, because we have these deviations, let's just say, where, you know, we break through support, but it doesn't really go anywhere. It just wrecks a lot of people, and that's frustrating because a lot of the time, you know, we as human beings, we're just greedy by nature. We don't know when to take profit, and I think that's half the time becomes one of the biggest problems, because we think we have this, and I think, by the way, I don't think it's a bad thing. Well, it is, but it's not your fault. I think the market has this way of giving you these ideas of stardom and get rich quick schemes and this 100x leverage where you are going to break out of the norm, let's just say, and you know, everything's going to be different and you don't have to work anymore, 9 to 5, you can throw that to one side. And it's so easy to succumb to that idea of this way of trading. But let me just tell you that very rarely works. And the more time I've had to spend reviewing data and reviewing these, I would say, market maker constructions, the more I start to forget about the fact that these are places where I want to long. So, like, you know, you'd be forgiven for thinking, okay, well, if I get a number of touch points, I'm going to use these as areas where I'm going to long. And, you know, you can say, okay, well, I've longed here and I've longed here. And that's a pretty good strategy, because you can see we've hit this line here, we've come up, we've done this kind of thing, we've come back down, someone else has got another long, but now we're coming back down to this line. And you've got to imagine, right, think of it like this. The people who are longing down these areas, it's all inducement, because when you're longing, because you've seen this happen and you've seen these touch points and you feel like this is going to be a solid line of support, you get to the point where you get a bit greedy and you start leveraging up, and you'll go 50x, maybe 75x, maybe even 100x. And the problem with the 100x is it's about 80 basis points before you get liquidated. And so market makers know this, and these zones here is where you're gonna ape in. Let's just say you're gonna put a lot of liquidity, and therefore you think, okay, this is gonna be a great point in which I wanna long from. And what makes it even worse, remember, liquidity is food for the market, right? So what makes it worse is you get two types of traders. You get the traders who like to reverse, and I'm a reverse trader, I like to reverse. But you also get breakout traders, the guys who like to jump on a breakout. Sometimes it will be a breakout, sometimes it'll be a retest and then breakout. And what tends to happen is there's this FOMO idea which comes in where you break out and then the break looks to have some sort of effort behind it, and you see a lot of liquidity coming in. So it's there to induce you to think, okay, I don't want to miss out. It's a FOMO idea where you don't want to miss out on the trade because you think it's going to start, dropping to the bottom, and therefore you'll dive into that trade. But of course, that's what happens. And I'm going to show you I'm not just going to speak about this. I'm going to show you some footprint charts in a second that kind of illustrate this idea. But you see where you'll build up into this price point where you'll just force through a trade because you don't want to miss out, and all too many times the price will reverse and you get caught out, specifically if you're greedy and you're 100xing or 50xing even. It's not going to be a good idea. So if you'll indulge me right for a second, these are, I would suggest, market maker based manipulations, right, where there's a constant fear, because think of the attrition rate is another thing you've got to think about. Think of how many new people come into the market with very little understanding of how the market works, and their idea of trading is support and resistance. It's like trading one-on-one. It's the first thing you kind of learn. It's about where are we going to reverse from, whether it's a support, whether it's a resistance. And they're all man-made kind of ideas, aren't they? They're all like there to define where you're supposed to, buy and sell and demand and stuff like that. So indulge me in the sense that I would suggest that these are manipulative patterns. Okay, so I'm just gonna get rid of that. And what I've done is I've took the liberty and actually put these patterns on a short while ago, actually, which I'll call inducements. Right, so I've just spent a bit of time looking at different touch points, data points, where you can see here. Let me just check that you guys can see me okay. Yeah. Touch points where, you've got, this kind of main line will be a support/resistance. It will act as support when the price is above, and it will act as resistance. And we know this because you can just see, touch point, touch point, touch point, touch point. So you when you get more and more data points backing up this idea, the more data points you see upon an area, the more times you can say, okay, well, this feels like, a solid line of support. So therefore, it's a support line. And then under here, it acts as resistance. And you can see, we only have a couple of data points here, but it acted as resistance. So we can draw quite a horizontal line and say that this is a significant area where we are both a support and a resistance line. And by the way, we've done no real analysis. We've not looked at, Fibonacci retracements or Elliott waves or anything like that. No structure. This is purely just looking at price action, okay? Just where prices respect in specific zones or areas. And then what I've done, as I say, is I've looked at where we start to get multiple data points, and I've drawn just a trend line. That's all I've done. I've not tried to be technical. I've just looked where we've got multiple data points, and I've said, okay, these are just data points where we are respecting a specific line or an area. And this goes right the way back. What am I on? Let's go to 30 minute. Same here. Yeah, you can see touch point 1, touch point 2. So I'm, making the call that will be another significant area. But I don't like to trade like most people will. Most new people, I should say that most new people who come into trading will trade like this, and that will be their ideas on trading. And it's a shame because it's the majority of people, and it should come to no surprise that this stat of like 95% of traders fail. More often than not, new money comes in, they get burnt, and then they go out, and it's because they don't learn some basic functions of how the markets are manipulated. And for me, what I want to try and do, and what I'm trying to educate people on, is how the markets are manipulated, and how when you look at these patterns, don't see them as entry levels and exit levels, but actually think of them as traps in the market where liquidity is trying to be built up, because we all know why it's important for market makers to build liquidity. And the simplest reason is because of you don't want a price impact. Let's just say, if you've got liquidity providers providing liquidity at different tick levels on, say, BTC, if you've got low liquidity at certain levels on a specific exchange, let's say Bybit or MEXC or whatever, if someone comes along with like 10 million worth of Bitcoin to buy or sell at a specific price as a market order, because they can't do it as limit orders, it's too much. If someone sees 10 million 10 million worth of Bitcoin limit orders, it's just like, it would just be absorbed by any kind of aggressive orders. So you don't want to see that. What they try and do is cloak by doing market orders, but they want to do these big exchanges and transactions where there's a lot of liquidity, where there's not much price impact. Because if you do a market order at a specific value, that's what you want to trade at. You don't want to trade where you get slippage and liquidity levels are really low. So there's a reason why market makers like to build liquidity at specific areas, and it's so they can exchange and essentially trap liquidity in areas. Okay, so that being said, let me just go into what I want to do, because I don't want to waffle on too long. So let's just say we've created some ideas on where price, and just as another one, you could argue that would have been one to focus on, just because it to the eye, and there's no science behind it. I'm just touch points, etc. Okay, now what I do, the way I like to trade, is I like to focus on zones in these areas. So if we look at buy side liquidity, what is buy side liquidity? Well, first and foremost, it's areas where there's going to be stop losses. It's areas where people who are breakout traders are going to be aping into specific areas because they think price is really going to move. It's areas where, just in general, liquidation levels, people who are 100x and 75x and whatever, where they've got really, short places to move. And it's like, okay, well, right now we are above price, so there's no buy side liquidity other than where we're currently at now. And like I said before, touch point number 1, touch point number 2, and then a couple of touch points here, so that we've got some level of certainty that the area here is a strong area where I expect price to come down. I expect commitment from buyers the moment we come down here. However, we also know how market makers like to move. They like to wreck people who are really tight with stop losses and stuff like that. So the way I approach trading, and not to be too greedy, is to use the zone beneath the line as a zone. And you might say, well, how far down does your zone go, and how do you know where that zone needs to be? Well, two things. I don't draw these like I'll just make it 100 points or 200 points. There is a bit more science behind it. I'm just using this as an area where I want an alert. I'm interested in longing if price comes down to this zone. That's like kind of tick box number 1, let's just say. And I've done this before we broke out here, so I'm just going to show you one other thing before we move on to footprint charts. The sell side liquidity, I've done this I think it was yesterday. It was on TikTok actually, but you can see where a number of points are being respected. So we had a touch point here, data point number 1, data point number 2. Now we have what we can call a trend, and therefore, we got this breakout. Okay, so big tick. I'm interested in a short at this point, but now it's like, well, with so many candles, Apex, which one are you going to go and short on? At which point are you going to enter your short? And this is what I wanted to bring to your attention. Okay, so you may have said, well, okay, let's buy the breakout. And again, remember, people who are breaking out here at the bottom of this candle are going to start aping in as a long, because they think, okay, now we're starting to moon city. Price comes up, comes back down, so on and so forth. We hit this point, and this was the top, let's just say. But this was the liquidity zone here, yeah? Why was this the liquidity zone? Let me just take that back. Because this was the point. Let me just get rid of that again. This here was the point. It was the highest point before, you know, the breakdown. So we were printing lower highs and lower lows. So we were looking like we were creating bearish structure, and then we broke through that. So that you always find liquidity above the previous higher low, let's just say, if it's in a bearish momentum, right? So we knew that this zone here, let me just mark that off, was a bearish move, right? I'm just going to call that sell side liquidity, just so we have another line. So we knew that the liquidity here. So the first thing you're looking at is, does this really break? For me, as I'm looking, does this break? Does this create my interest, this candle specifically? Not really. I want to see it break the higher low. And then it did, okay? So the next, so tick box number 1, we've broken out of a pattern, okay? Now I'm interested. Tick box number 2 is, let's respect and let's see how we react, because the reaction to the move is the most important thing, right? And this differentiates you as a FOMO trader and you as a calculated thinker, okay? So we're just going to move over to, let's just look at this candle here. This one was at, so this was the 1st of March, and it's easy looking back, I'll grant you that. And it's not always, by the way, I wouldn't have been awake to take these trades, so it's not like I'm saying, wait, I took this trade and I'm, you know, doing great. If this would have happened during a normal day and I was awake and I was during normal times, I definitely would have taken the trade. But it happened during the Asian session and I wasn't awake, so I'm not going to take credit for that. But I just want to recount and recapture, you know, why it's an important thing to think about this in this way. So this candle here, right, was at 4:45 on the 1st. So let's go to 4:45. This is now XO charts, okay? We're going to go 4:45. Okay, so it's this candle here, yeah? This was that candle. Let me zoom in a little bit. This was the candle that broke out. And it's a really powerful piece of software, this, because it gives you, it tells you actually, let me just make this a little bit easier on the eye, guys, because it might not be too great. Hang on. So it tells you a few things. It tells you that, like, let me just expand that a little bit. There you go. I'm not sure how great this looks, I've got to be honest. So just at a glance, you can see how this candle looks, right? What the bloody hell am I doing? Guys, I'm sorry about this. That's the candle there. 4:45, we have the breakout. Now what you're looking for is when we hit the top, right? So forget about this right now. You can see the delta, and the delta is how many more buys than sells there were at this time. And it was 2.4 thousand more Bitcoin to the buy side, as buy side liquidity at this candle. So very bullish. You know, there was 12,000 Bitcoin traded at this candle, this huge candle here. But there was 2.4 more of that 12k that were buys. So the delta was higher. So let's just try and look a little bit about the imbalances, right? Because it's the imbalances that tell you the picture. Let me just change, not to bid ask, but let's go. Do you want to try delta? Let's try delta. Okay. As we get to the top of the candle, you can see it's pretty evenly matched. There's no real delta at the top. So that tells you one thing, right? For me anyway, there's no imbalance. And you can see there's imbalance here, but you get more buy side liquidity. That means that where you see these green areas here, the buyers are in control. There's a lot more buyers than sellers. That, and from a common sense perspective, that means that the buyers at this stage, irrespective of whether it's retail or whatever else, And these are aggressive orders. These are market orders. These aren't limit orders. So these aren't passive. These are all market orders that are going in. It means there's a lot more interest for buyers at this level than there are for sellers. But the problem is you start to lose a little bit of liquidity. That means that there's no one else willing to buy when you're seeing zeros on the sell side. But there's still, you know, you can see each one of these is a tick, a different price point as we're going up and down. You can still see that there is interest from the sellers at this stage, right? And then we move down. So then it's like, okay, so this is a 15-minute candle. And in comparison, you know, you just had a huge move to the upside right the way up. The point of control, so most traded volume is here, right at that 23,800. Makes sense. It's a round number. But look at the reaction. Reaction was pathetic. Had this big push to the upside. And then remember, you know, we're looking for the reversal. But we're not interested in selling at this stage because we haven't seen any clues in this candle that that buyers are starting to fade out. You need to see a lot of buyers starting to lose interest at a specific level. You don't want to buy when it's high, do you? Let's be honest. You sell when it's high and you buy when it's low. So basically, next candle comes in relatively weak. Next candle comes in again relatively weak. We're not seeing any signs at this stage. Just going back to where we are. So this is that main candle here. We get this choppy action. What I'm interested in is this candle, right? Because we can see the wick. So it's like, okay, what's going on here? And this is at 8:45. So we'll forget about all of this piece in between. The idea is that we're in this kind of liquidity zone, but we're not interested in a short just yet, okay? But this is the biggest clue. So that's this kind of up and down action, small candles, not really too much going on. And then we have this, okay? Don't know if you can see that well enough. But you can see how many people, there's absolutely no one here willing to sell at this point now. Sorry, willing to buy. You can see all the buy side liquidity has gone. Yeah, and look at the sellers. Sellers really stepping in. So buy side liquidity from 24,000, 1,600 right the way up to 24,028. So, you know, it's not a lot of ticks actually. But if you're watching this in real time, okay, so you've already ticked a box. Remember, you've ticked a box that you think, okay, I'm interested in the trade. It's in a zone where I'm really comfortable for reversal, but I need to see a waning of the buyers. And this is the clue. This is what we call trapped traders, because all of these people here, there's no one matching on the buy side because buyers aren't interested in buying at this stage. So all of these are just getting filled with what's available in the limit order book. There's no aggressors. So what that tells you is the zeros here, there's no new market orders coming in. But the sellers here are getting filled on on limit orders, okay? I hope that makes sense. It's just telling you one thing, that there's no one interested. So if you've got two ideas. Number one, you're in a zone where we've already bypassed an area where it's, you know, retailers have been blown out because, you know, think of like short liquidations and stop losses, etc. Now we're looking for the clue of when do buyers start to lose interest. And this is just like the perfect example. And we see this all the time, by the way. This reduction of buyers. So, you know, it's not the perfect entry, but by all means, you know, let's go back to TradingView. You know, if you get an order when them zeros start popping in around that 24k mark, and then where'd you get out? Okay, well maybe you say, well, I'm gonna wait until we come back and retest the, you know, me line, me retail structure, and that would be, let's just look at the move. Nearly a 650 point move. You know, it's not bad. So there's a few lessons to be learned. Okay, so lesson number one, it's I think it's counterintuitive, but to draw out where the majority of people will be putting their orders, their commitment. Lesson number 2, identify the zones. It doesn't have to be perfect. I've not put any science behind this. I'm not really interested in, well, I am interested in daily levels and high turn time frame and volume zones and stuff like that. But more importantly, I'm interested in seeing how the reaction is once we kind of cross the threshold. So I don't want to keep this too long. I just thought I'd come on and give some thoughts and ideas of just something that I think is important to look behind the candle sometimes around when you seeing what's there. It's not always about just, support, resistance, volume, Elliott waves and whatever else. Sometimes it's just about pure raw price action and following what's going on. So hope you guys enjoyed it. I'll leave this